Hey everybody. Well, here we go again. Another week, another emerging market coming under pressure. Tonight, European time, we are seeing the Brazilian real taking a real beating after the Brazilian central bank has intervened to prop up the currency, but it's to no avail. The currency is under very significant pressure. It very much looks like a replay of what we've seen in Turkey, what we've seen in Argentina. Brazil simply looked like the next emerging markets to take a beating. I can't say I'm surprised. We have hinted at that. I think actually I've been quoted on Bloomberg earlier today saying that Brazil could be among the next victims. And why have I been pointing to that? Well, I have to repeat the story that I've been telling in recent weeks, if not actually since February. The fact that the Fed has moved to tighten monetary policy. We continue to see the reduction of the Fed's balance sheet. We continue to see the Fed hiking rates. And now we are even getting talk from the ECB that the ECB might be stepping up in terms of tightening monetary conditions going forward, at least in terms of scaling back quantitative easing. So we have a Fed meeting next meeting. You have the ECB clearly worries in the markets about tightening of global monetary conditions. And who would be hit by that? Any countries where we have large funding needs, countries with large current account deficit or with fragile public finances. And here Turkey stands out, here Argentina stands out, but actually Brazil stands out even more. Actually, last week, I'll just get my Excel sheet on the screen here for myself to watch, and I can read from you. Last week, I did some calculations on what we call the snowball effect. When is it that interest rate would get to such a level where you will get an explosive growth in public debt? And actually, Brazil has extremely low threshold levels for interest rates. Brazil is running a primary budget deficit. Like Turkey and Argentina, slightly larger than Turkey, somewhat smaller than Argentina. But contrary to Turkey, Brazil essentially have no real GDP growth. And of course, we have around 5% inflation. So that gives us nominal GDP growth around 5%. With monetary conditions tightening globally, with the dollar strengthening and potentially also commodity prices coming down, Brazil looks very, very vulnerable. And our calculations actually shows that as long as interest rates, bond yields are above 2%, 2.5% or so, public debt is ever increasing in Brazil, unless there is very significant tightening of fiscal policy. And in that situation, investors will run away. It becomes a self-fulfilling prophecy when fiscal policy is too easy and you have no growth. You know, the only way you can solve that problem is through higher nominal GDP growth, and that can only happen through easier monetary policy, hence through a significant weaker currency. So what we're having now is a full-fledged, some unpleasant monetarist arithmetic event, as we've seen in Turkey and Argentina. And I'm frankly not too surprised that this is happening. There are two ways to do something about this. There is a short-term panicky thing, and that is, of course, to tighten monetary policy, like we've seen in Argentina and Turkey, and ramp up rates dramatically, and that's probably what the Brazilians will move towards. But the effect of that is, of course, a significant slowdown in growth and in nominal GDP growth, which in itself would worsen public finance situation. So the real thing you ought to do in this situation is to tighten fiscal policy. But given the political situation in Brazil, that's very hard to see. So that's similar to what we're seeing in Argentina and partly similar to what we're seeing in Turkey. So for now, Brazil have joined Turkey and Argentina. I think they will choose the same remedies as Turkey and Argentina. The central bank will be forced to tighten monetary policy, ramp up interest rates aggressively to stabilize the currency. But the cost of that will be a significant slowdown in economic growth. Here we have three of the most important emerging markets in the world being hit. The question is, are there other emerging markets on the list? Well, I think we are some way away from the next one, but if commodity prices start to decline, Russia could be a candidate, but I will also look back to the Eurozone. Greece, even though has been stable recently, could actually come back in the spotlight. And of course, Italy could come back in the spotlight. A lot of this has to do with the fact worries about the ECB tightening, worries about the Fed tightening. Are they tightening too much? And if you're vulnerable like Brazil, Turkey, Argentina, you will take a beating. So for those, I think these currencies will continue to be under pressure in this environment. What we really need to see something fundamentally that can stabilize the currencies in these countries is actually not monetary policy action, it's fiscal action. And that could be very, very challenging. Of course, we could also be saved by a dovish Fed next week that could stabilize the situation. But no doubt, with maybe 3 more rate hikes in the cards from the Fed this year, we clearly could continue to see pressure on emerging markets going forward. So stay tuned and remember, next week we are publishing our global monetary conditions monitor, our quarterly monitor on global monetary policy, covering 26 countries, including, of course, Brazil, Turkey, and Argentina. So stay tuned. And if you pledge $10 monthly on Patreon, then you will get a subscription for free. So please sign up and be careful out there.